Many investors and traders are claiming that volatility is dead, and that's because we haven't seen it in a while. It's been 41 plus days since we've seen a 1% drop and over 300 since we saw a 2% drop in one session. But could that all be about to change in the month of July? Today we take a look at how the market rejected some very key pivotal points and how now it might be setting up for what we call a Wyckoff distribution. Dark pool activity and large Wall Street bets seem to be possibly making this call as well. So in today's video, we take a look at why some of the leaders are now starting to fall behind and whether that's a good or bad thing for us as investors and traders in this market. Stocks, commodities, and cryptos coming up in our special weekend edition. Let's get into it, guys. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's special weekend edition, we'll be discussing everything from the macro to the data to the leading stats that you need to know about markets right now. Also, options and Wall Street flow. It's coming up in today's show. And if it's your first time here, remember to subscribe and smash that bell icon. Well, let's get into the first discussion. It's been a while since we've seen extreme volatility. In fact, it's been over 41 days now since we've seen even a 1% daily decline on the S&P 500. And that's starting to get up there with some of the other periods that we've seen in history that tend to bring vol with them. This is a great chart here from Macro Charts, but it puts in perspective something we were discussing last week. That it's been a while since we've seen a 2% down move. And of course, I would say probably about average, not even yet, for a 3% down move. So could we get volatility coming through earlier this year? Well, as you might be aware, this year is a very important year from an election standpoint. Not only is it the most important election, the US one, but we've also seen many other countries around the world going to the booths in 2024. So what changes? Well, it looks like the volatility is probably going to start increasing sooner than later. And one of these reasons has to do with the VIX structure. Now, as you'll notice here, in 2020, we saw it start way earlier, back in kind of August, where the VIX started to spike all the way into that kind of September, then November point. Now, will we get it again? Well, the VIX is certainly suggesting yes. And one of the interesting things was on Friday, we saw some huge dark pool transactions go through in the VIX ETFs. That's coming up later on today's show, but it could mean that vol is just around the corner. Now, another reason why that could be coming is because puts have started to kind of drop out of the markets. Now, we'll talk about just the 0 DTEs moving forward for the week, but when you look at a 25-day put call ratio, you'll notice that we're back down to where we were in March, which ended up getting us a little correction. That 5.5% correction came through at around that period. And while I don't think this is terrifying and it's going to start something that's incredibly worrying in the markets, it could give opportunity to people that are looking for a bit of a pullback after what has been, of course, another historic run. Now, what about underneath the hood? A lot of people complaining about breadth, and that basically means less stocks are making new highs and they're starting to make new lows or decline. Well, yes, that's exactly what's happening. If it wasn't for semiconductors and some of the big tech stocks, you can see here some of these markets, in particular the materials sector, which has copped a massive hit, and the energy sector, which we'll specifically talk about later because I think that's starting to improve, have been hit very hard. So if you look at it, materials, energy, and utilities, sectors that were very hot only a few months ago, they blew off and now they've come back to very important bases. Will this be a level that I'm looking at? Well, I think all of us will be, and we need to discuss that on the charts. But let's have a look at Wayne's data. We love Wayne Whaley. He's got great data over on X. You can follow him there if you're interested. And what he does is he goes back and finds relevant information to the current market conditions. So what he found is that after a week of June OPEX week basically being negative, then we ended up going into some interesting kind of reads. 13 up, 5 down into the 4th of July holiday, of course, this week. And then we go through and we notice that if we went through kind of the middle of the month, we generally were very bullish. So if we're going to see this vol, generally speaking, it's going to have to happen over this first kind of period here, as you'll see, and then it usually will go bullish very quickly. So it's kind of suggesting if we do see a volatility spike anywhere in this kind of 15th of July period, that we're probably looking at it being short-lived. Now, that's an interesting stat. We can back it up with this interesting stat as well, which basically says that the first day of the trading month in July is usually positive. In fact, it's the greatest day of the year historically. And while I never look at this itself and say, wow, that's just going to mean I need to buy, it is 90% up over the last 21 years. And you'll notice that it's 19 up, 2 down, and the factor is not too bad in terms of the average gain. You'll notice here it's still almost 0.5% on the session. Now, why will that be important? Well, really, I think whenever you're looking at stats, you need to look at price action and technical analysis first. But you also need to understand what you could even expect in most years. Now, this being an election year, even if we do see volatility start spiking July into August into September, we can't really be expecting much more than maybe an 8 to 10% pullback at best, considering the stakes of what's going on this year. There are powerful forces, of course, going on around the world right now that are making this market be very resilient and driven by things such as AI causing concentrated market. As we know, when a bubble starts, it tends to go further than most people can even kind of conceive at that time. So here's another great chart from Grant Hawkridge over on X. And I like this one because basically what it's showing is that you will have some form of sector that tends to roll over a 12-month return of negative 20% or more before the market actually drops off a cliff. Now, last time before it dropped off in 2022, guess what it was? It was communications. Before that, it was energy. Before that, it was energy. Before that, it was financials, which of course led us into the global financial crisis. And it's one of the reasons that I am watching also things like KRE and XLF very closely, because I agree with this chart. If something starts to fall off in a big way, we need to be paying attention to it, especially if it's underneath the hood and less people are talking about it. Now, this will be something we follow over the next couple of years. And as we know, we're in late cycle investing. So make sure to subscribe to the channel if that's something that will interest you, because of course we'll be alerting when we do see it. But for now, do we see a market crash? Well, the simple answer is probably not. And it's driven by forces such as this. And the first one is, of course, being the rise of the buybacks. If it wasn't for the buybacks in stocks over the last 10 years, the market would nowhere near be as strong as it is right now. But as we know, buybacks are starting to accelerate through this earnings season, particularly in the most important big stocks. And companies like Morgan Stanley, Goldman Sachs, Bank of America, and everybody else are starting to put out these projections, which basically mean they're going to buy. And what they're doing is they're saying, look, we think in the market, we're going to see continuous strength. And in fact, they're out looking now in 2026, 297 for the stock market. So they've got some big hopes for the future, and they tend to still think that there's a lot of growth going on in the market itself. Now, here's a great one, the big four indicators since the end of the recession in 2020 all the way to now. And you'll notice that employment, of course, has been strong. We all know why. And then industrial production's been up, down, and all around, but generally pretty decent in the recent reads. Retail sales, which we know that we're tracking using a code called XLY versus XLP, that's been increasing a little bit after being up, down, and all around. And real income continues to become sticky. But at the same time, it doesn't usually lead into a crash in the markets just yet. So that's important, as is this chart. This chart shows us that if we are following, remember, the 1960s or the concentrated run of the dot-com boom, we've still got more to go. And while we might be going into a little bit of, kind of weakness here, and specifically we'll be looking at the charts on the smaller timeframes in a moment, that it probably won't lead into a significant drop back just yet if we continue to follow what has been historically pretty close together. So let's talk about the short term right now, the large transactions coming through. These guys haven't been that wrong recently, with huge dark pool transactions leading to the VIX decline and a big one coming through on Friday, which possibly is going to lead into the VIX starting to increase. Remember, it's been over 41 days since we've seen even just a 1% daily decline, and this has the hallmarks to start a little bit more. Now, why is that? Well, it comes back to these large transactions going through. Two massive ones going through the queues last week, huge amounts of ones going through one of my favorite stocks, Microsoft, that continues to get piled into. And I'm not sure if you agree or not, but that doesn't really look like accumulation to me. It looks like someone is probably selling pretty large positions of Microsoft, looking for a pullback, and then maybe they'll buy back in. The same kind of thing is starting to appear in some of the major indices as well. We've got another one here from the 3X fund of course, Russell 2000. And you'll notice there are now 3 trades in a similar period. Are these all sells? Are these buys? I think will be proven correct or wrong this week because, of course, a huge transaction went through straight into the Friday close right around that point, and it may be a sell. Let's talk about why this could be. I think it's the reinflation trade starting to come through. And there are 2 signs of reinflation possibly starting to take hold. One, the CPI for Australia was hot. The CPI for Canada was hot. The CPI coming through for a couple of European countries, a little bit up on the tick. But here's one that I think is interesting. Hedge funds are going super bearish on oil. And you might instantly say, well, that means that we should be therefore going short on oil. Well, as I mentioned in our last video, go check that out. I actually lined all of those periods up and you'll notice that at least temporarily, oil tended to actually go bullish off that period of time. Global central banks as well are still hugely purchasing gold. And as we know, this is kind of similar to the 1960s run. And this kind of points towards, I think, currency debasement to a degree. And of course, the big CW word, which basically means that we have BRICS versus SWIFT coming up over the next 10 years. This is going to be the big discussion. And I would highly suggest if you're not familiar with BRICS and SWIFT, stick around on the channel. We'll discuss it more coming forward. And of course, make sure you're aware of both of those things. Let's talk rotation before we jump into the charts and look at the S&P 500 and the options flow. And you'll notice here that regional banks and energy did okay over the last 5 days. In particular, really, regional banks came strong on Friday. Now, this is important. If you're getting banks up, you're getting energy up, you're getting metals up, some of the things that have been hit a little bit recently, that's fine. We've seen a rotation into semis, into tech over the last 2 months. Before that, it was metals, energy, and all these things. And we don't really want banks in particular to be getting absolutely trashed. Remember, that's a bad thing in the economy. If you go to Friday, it was banks or regional banks, it was metals, semiconductors kind of found a little bit, they just held, and energy itself also did better. And then, of course, we've got big banks behind it, and then home builders as well. So really the sectors that were down were some of the ones that have been going hot recently, or some that won't do very well if we don't get cuts on the horizon. So let's jump in to see who won from the bull and the bear perspective on Friday. And this was a close is the key kind of day. And we often talk about that and we say patience, react, don't predict. In this case, we had 54.90 hugely marked out, 54.90, 5500, and of course 55.20. These were all resistance levels through the Friday session based on options markets and also this high over here. And the market went bullish, made a new high, and then rejected back. Now, I'm sure if you pause the video here, put it in the comments down below, what does this type of pattern start to look like? Now, I'll just leave it for a second, but if you said a Wyckoff distribution, I would tend to agree with you. It has some of those hallmarks. Let's first up go to the weekly here straight away, and you'll notice that we're starting to get a little bit extended. Now, is it perfectly normal for the market to go up on epic runs and then have these types of little sell-offs? Absolutely. And you can see here that we're starting to get some reads on this indicator that's basically pointing towards exhaustion in the markets. Now we go over here and we can see that we've got this rejection candle. Now, of course, if we get close above 55.25, the market's going to, I think, explode and go super positive gamma and everything. But this marks out 54.50 as being even more pivotal for the bears to sell off. And if we actually have a look at the futures market, which we'll do in just a moment, we'll just quickly look here at the intraday so you can see how it traded. It went up through the morning and then sold all the way into the close itself. Now, if you have a look here, you'll notice US 500 futures, same thing. A rally through the start of the session, a sell into the close, almost hits that 54.50, pretty much does actually, 54.50 support, and then finds a buyer off that, almost closing back on the futures at the most traded zone. So what does this mean? Well, it means that we're basically stuck in a zone or a range. If we go above this area, of course, I think the markets could go ballistic. But if the markets go underneath 54.50, 54.40, it's going to open up a huge negative gamma trade. And as we say, could create a cascade effect to push us towards the next level, which is going to be down at 53.50. Now that's going to only mark, if you can believe it, from the top to the bottom, a 3% pullback. But that's something that we're certainly looking for in the markets. And if that level is broken, then you're talking 52, kind of 50, 52.40, which is starting to get into that nicer correction zone. So why is this going to be important? Well, this level is just so big. And with the now new high that was formed here, plus on the NASDAQ, you can see that a lot of people probably lost their short positions through Friday. So they're going to be unhappy with that, and rightfully so. It's definitely a bit sneaky. But if it does something like that, then you're kind of looking at it as a wyckoff, and that would mean that this was, of course, a false push to grab liquidity, and then it basically would start that volatility. You'd expect something like that 1% stat day to be broken. Let's have a look at the options market. Does this make sense to happen on the first trading day of July? Well, maybe not. As you can see, we traded into the level of 54.60 by the close, and there are a lot of puts sitting around this level for the first trade day. Now, that means we're a negative gamma situation. If the market does push below 50, kind of 450 zone, I would say that it will start to cascade, and this will need to be hedged because, of course, the dealers will be offside. But this may also, and probably will, act as a bit of a deterrent from the market to go down. So it's going to be watch and see the closures that'll be key here. And you'll notice that when we go to the next trading session, the calls at 54.50 become extreme, which points to me to be possibly actually going to push the market down. So it may not be the first session, but maybe it's going to be the second session. Because look at here, the put wall doesn't actually show up till 53.40, which funnily enough is exactly where we see that options level / market technical structure. So that's what I kind of like to see on markets. You know, why is this random amount of calls here? What will happen in the next session? This becomes very important for day traders, and I think those levels all need to be watched. We also saw CTAs start to dump positions, and there, of course, momentum funds, a fall down there of CTAs in the NASDAQ, same on the S&P. But where the CTAs became most interesting was Brent. Now, we've been talking about possibilities of energy going long. Have a look at that CTA. Wow, that's commitment. They went wild, and they certainly liked their oil over the last couple of sessions. And that could be, of course, spiking oil across the board. Gold also saw a big uptick in terms of the CTAs, and copper also saw the same thing. So as we hit kind of key levels on, of course, oil, copper getting close to that 425, very key zone here, and gold just barely holding on. Interesting that all across the board, we saw CTAs pile into those particular positions. When we take a look at the probably biggest stocks right now that everyone's discussing, Tesla was a bit of a win last week. We've been discussing that now for a while, and congratulations to anyone that took it into 200. That's probably a smiley face for you guys, and it just shows you that reading the price action and having a great understanding and patience in the market can net you superior returns. Now, can it get better? Well, I think it could. And of course, 200 will continue to be the most important level moving into this July's OPEX. And as we know, we're kind of moving into a positive gamma situation with a lot of calls across the board if that level's to be broken. The weekly did okay, but it wasn't able to get above 200. We'll look at that soon. NVDA, well, this is a mixture trade. As we know, 120 held up last week, which we expected it to, again, based on options. This week, the possibility of a 115 becomes, I think, a bit more real. This is a negative gamma situation. So basically, the more the market pushes down, the more it kind of feeds upon itself down to the key levels. And at the moment, it looks like, based on this week, the 115 could be a real deal. And we'll look at that chart in just a moment. Let's jump into the overall technical indicators. First up, what is the bonds market telling us? Well, bonds and options, they've spiked a little bit, and they're still off their lows of where we were at the start of May. So a little bit worrying. When we have a look at yields, they started to kind of come up a little bit after the call PCE. Even though it was in line, we saw a big move in kind of yields, about 1% across the board. And when we consider something like the bonds indicator that I haven't brought up in a while, that's actually been weakening in recent weeks. So alert set at 114 ratio for us here. That'll tell us whether we have to expect something a little bit more extreme in terms of a correction. And what I'll be looking at this for is, along with that vol structure that we see from the VIX, if we see the VIX spike up big time, if we see a lot of geopolitical situation stuff come in, price action obviously goes negative at the same time, this could be an indicator of whether we're going to get that 8 to 10% correction versus, more of just like a 3-4% or something like that. XLY versus XLP continues to do well, showing that the American consumer, whether they are really doing well or not, who knows, the market believes that they're on the spending spree. And that's probably because when you look at some of the leads, such as flights going on around the world, especially in America, domestically, they're hitting all-time highs. And we showed that in our last video. Let's move over to regional banks. Regional banks making a very nice weekly close back above some of those rejections. And of course, kind of pointing towards an upward tick potentially in regional banks. If that does continue being a huge part of Russell, that will be a key point. Copper comes off its weekly 20 moving average, not quite down to my 425 zone, which I prefer, but that does see some CTA action. And as you can see here, there's no signs of real pickup in the price action yet. We're looking for that 20 moving average to be broken and closed above, plus some structure signs. We'll update when that happens. US oil, not bad weekly close, pretty crappy daily. Obviously, long leg doji at the highs. Would have preferred to see that clear 82 and find a buyer, but we're still looking towards 84 to 84.50 a barrel. And like always, whenever you're looking at oils, you should look at both Brent and, of course, crude. And you can see both of them struggled through the Friday session to hold their gains. Meanwhile, energy stocks, they did do okay. They held the weekly just above the 20 moving average, and they're just trying as best they can to break this descending channel that we've got here. And I don't think that many people are looking at the energy sector, which of course is generally something that makes me a little bit more excited. Let's move over to gold. Gold came off the most traded level, fell down, long leg doji, same thing as the previous week. Gold has no idea what it wants to do. The overall trend is still down. We haven't broken to the uptrend yet, but we'll be watching both ways. And if you've got like a longer term perspective, yes, I do still think gold could go longer, and I still think it's going to hit $3,000 an ounce over the next 12 to 16 months. However, it could easily go to 2160, 2180. So we're just watching to see the price action, and that's that patience kind of factor coming in. Let's move over to Tesla. Long leg doji on Friday means indecision at the peak. It hit the 200, so well done to anyone that got that. But I wouldn't mind to see some more. And of course, that comes down to inverse head and shoulders going towards 260. And if the market's able to break above 200, I could see a lot of retail traders heavily start to push this in. And the weekly, while it closed right on resistance, it was still a strongish close, holding up and not wicking too much. So certainly a stock that I'm still looking towards the bull side. Meanwhile, NVDA, that looks like it's probably still topping. As we've talked about several times, we're looking at the semiconductors to find a bit of weakness for now. After this occurred, we kind of expect this to occur and then it to resume later on and probably have like a 1 to 3 month sideways to down kind of action. Semiconductors is the same. You can see here barely holding on versus the SPY to its 20 moving average. And one of the things we're looking for is a pullback to mean reversion. Look how beautiful that's been for buying. And we've often brought this chart up quite a few times. So not bad. I'd be looking for it down to there. We'll see whether it can get there. What about the metal sector? A few people have asked about this. You can see the metal sector is at an important point, needs to start turning to the upside. And this is in line with, of course, copper as well, hitting some of those key points. Aussie 200 indices now and some of the major ones before we go to the US. This one's stuck in the middle of nowhere. A few people have asked for it, and I don't really have too many opinions. I'd say it's still in an upward trend. If the metals and energy market and banks start to improve, then this market does best for that. Why? They're the main three sectors in the Aussie market. So, of course, we're looking for that improvement to come through. Meanwhile, the Chinese market has continued to kind of disappoint a little bit here. It's not quite to the 61.8 fib retracement, but as you'll notice, if we go down to the daily, not a great close. I would have liked this one to hold up last week above this high and to find that new breakout, obviously giving us the swing trade that we were looking for up here. But I do remain quite, confident in it over the next, multiple months, because I do think that the government is putting in place quite a lot of money to try to keep this thing from going down anymore. And we've already talked about how many shorts are already in it. US 2K did better than you would expect. Big dark pool transaction came through here. You could argue it's starting to break to the upside. Really, for me, unless it gets above 2100 plus, I'm not going to call that, because while I don't mind investors that bought around 2000 and this level down here, I do think it needs to clear this level pretty much this week here before it starts to get real momentum. It's still in that weird zone at the moment. Let's move over now to the US 30 and have a look at the Dow. So the Dow held up better than some of the markets. Again, long leg doji 1, 2, 3. You know what that means. If we get a break either way, it's usually more explosive coming off that pullback zone. Still at the support as we see rotation go through. And the NASDAQ was an interesting one because it actually went up and then fully rejected. And have a look at the weekly here for the NASDAQ. So it ends up as a long leg doji, but to me, it's the Qs that I'm looking at. So if you look at the Qs, which is the real market open, you'll notice that it rejects after taking the high. So it actually takes the high similar to the S&P, then it just rejects straight back down, closing near the lows. And I always say when it closes near the lows or right on them, that there could be more to come. So again, this is kind of setting up with key levels here for the actual Qs to be set at around 474 on the Qs. This is a very, very important period of time. And while at the moment it's just sideways, if it starts to break to the downside, it could create, like the S&P, a bit of a cascade event where we see selling across some of the biggest stocks in the world. And the big stocks that you'll want to be looking at, of course, will be the ones such as this one here, which is the magnificent kind of 7 stocks. And you'll notice again, they've rejected. This is not the first time we saw this. We saw weakness through Feb into March, hits the low in April, rallies on. Guess what? We got the same thing in July into October of last year. And this is kind of what the market's been doing. It's been moving forward with the most powerful structured levels. Then it's been consolidating for a few months. Then everything else, breadth has started to improve. And then again, we see an uptick in these particular stocks. So based on the Microsoft huge transactions going through, I think it might be that there's a little bit of weakness moving forward here in those particular sectors. And you can see here on Microsoft, it's starting to point towards, on the daily anyway, melt up that could be starting to reject. This is certainly an extended level with a lot of trades going through. Let's now move over to crypto market, which has been a little bit catastrophic recently. Series of lower lows and lower highs. It pushed down to that first major bull zone of 58.4, 58.5. It's got to the 61.8. It needs to make a new high. So you want to mark out 62.5 this week for temporary bulls to kind of push towards 64, 64.5. But real bulls will not really get back into this until 67.4 from a big swing perspective. And at the moment, if you're looking at this chart, you'd be very worried about 58K getting taken out. If it does, next zone, 51, 52. So I think that it's very important that Bitcoin starts to solidify this 58.4 base, and it needs to do it over the next week. And speaking of this week, we do have some data coming out. In general, we have Fed Chair Powell annoying us on Tuesday, and he'll be coming out to discuss at 9:30 a.m. whatever's going on. Then we've got JOLTS job opening straight after that. And this week is the jobs numbers. So we've got ISM Services PMI on Wednesday at 10 a.m. New York time. Then we've got the FOMC meeting minutes on Wednesday as well. That'll be interesting to see what they're talking about. And the big one is going to be the jobs numbers on Friday. Non-farm payrolls, as we know, this is what kind of the market's starting to look at along with CPI. And it's expected that the jobs are still going to be strong. Unemployment's going to remain around 4%. So let's see how sticky this inflation is and how sticky these jobs are. Thanks so much for watching, guys. If you enjoyed today's video, remember to subscribe. Have a great weekend, and we'll see you in the coming week because things are, going to get very interesting. And remember, we do have July the 4th sitting right in the middle of the week as well, which basically then will split it a little bit and we might get some pretty big vol on either side. Catch you for now. Bye.